Welcome. This podcast discusses recent developments in the U.S. stock market and provides analysis and opinions on major companies and market-moving events. The information presented here reflects opinions and interpretations of publicly available data and is provided for informational purposes only. It is not investment advice. Every investor should conduct their own research and make decisions based on their individual financial situation, risk tolerance, and future expectations. One of the key recent developments affecting the U.S. stock market is news related to artificial intelligence and cybersecurity. Anthropic released an article titled "Making Frontier Cybersecurity Capabilities Available to Defenders," explaining that its AI model, Claude, has demonstrated the ability to detect novel high-severity cybersecurity issues. This suggests the company may introduce a cybersecurity-focused product, possibly referred to as Claude Code Security, designed to protect AI systems and software infrastructure from attacks. The article states that this system is built on over a year of research, but no fully usable commercial product has been released yet. This announcement created uncertainty across the software sector. The iShares Expanded Tech Software Sector ETF declined, and many software and cybersecurity companies dropped alongside it. CrowdStrike fell about 10%, Zscaler fell about 10%, Palo Alto Networks declined about 4%, and Microsoft also declined. These declines appear to be driven primarily by speculation rather than changes in company fundamentals. The opinion here is that established cybersecurity companies have strong capabilities and infrastructure, and any new AI cybersecurity solution would likely be integrated into existing enterprise ecosystems rather than immediately replacing them. The cost of AI development and deployment remains high, and it may take 10 to 20 years for new entrants to fully compete at scale. Additionally, AI companies such as Anthropic are still operating at a loss, and long-term monetization will likely depend on business-to-business partnerships with existing software providers. Another major factor influencing the market is tariff-related uncertainty. Trade tariffs previously introduced were ruled illegal by the Supreme Court, and new tariffs of 10% were introduced, with the possibility of increasing to 15%. These tariffs are expected to remain in place for approximately 3 to 6 months, creating short-term uncertainty for companies operating globally. This type of policy uncertainty historically creates volatility in the U.S. stock market, often leading to short-term price movements without necessarily changing long-term company fundamentals. The opinion here is that valuation levels should remain aligned with growth expectations to support long-term sustainability. Portfolio allocation data provides additional perspective on exposure levels to major U.S. technology companies. Current cost basis allocations include $4,900 in Meta Platforms, $3,800 in Alphabet, $4,600 in Amazon, $4,600 in Microsoft, $3,400 in Nvidia, and $3,300 in Visa. These companies continue to represent dominant positions in artificial intelligence, cloud infrastructure, semiconductors, digital payments, and global digital platforms. Overall portfolio performance currently reflects a decline of approximately 5.22%, which remains within the normal range of volatility for equity markets. Market volatility driven by emerging technologies, policy changes, and speculation is a normal and recurring part of the U.S. stock market cycle. Despite short-term fluctuations, the long-term outlook for leading technology and platform companies remains supported by strong fundamentals, large addressable markets, and continued innovation in artificial intelligence, cloud computing, and digital infrastructure. Subscribe to the channel to receive all the latest analysis and updates on the U.S. stock market and major companies shaping the future of the global economy.